Hello, I'm Giselle. We've been talking about buying and selling businesses, scaling your business, and I've been giving advice for business owners and people who want to start their business. So today we are talking specifically about selling businesses. I realized that I didn't have a so thought through tutorial on how to sell a business, and I know that some people really need the step by step on how to do it. So I decided to really talk into detail on how you will end up selling the business. So first things first, you will value the business, right? And we already spoke on how to value the business here, but today I will show you how to do the calculation yourself, really step by step, so you can follow through. So let's go. So here we are. We're going to do a simple valuation calculation. And the first step to get this valuation done is we will have our sales figures, our cost figures, and our expenses. So basically, if you don't know what costs are, then I doubt that, but let's say you don't know. Basically, your cost is everything you spend to produce your services or products, right? So it's the cost of goods or services sold. Your expenses is everything else, like marketing, you have payroll, etc. Sales, of course, is the sales of the business. Why is this important? Because we will basically subtract the cost and the expenses from the sales, and we will get to our EBITDA, which is the earnings before interest, tax, and depreciation. You don't need to know what's that in detail. You just need to do what I am saying. So it's sales minus cost minus expenses, and we're gonna do this for year 1. We'll do this for year 2 and also for year 3. Good. So now let's suppose that you have a small business. If you have a small business, maybe you are earning, let's say, not earning, but you are producing 100,000 per year. Could be that in year 2 you made 130,000, whereas in year 3 you made 150. And then let's exemplify. Let's say that the costs of the business are like 20% of your sales, whereas the expenses are like just about 40%. With that in hand, we know that your EBITDA is about 40, 52, 60, and again, it's just to exemplify, right? What we want from this calculation? Well, we want to get the average EBITDA for the past 3 years. And here EBITDA is wrong. Let's get the average, and then the average is 50K. So you know that the average EBITDA for your company for the past 3 years is 50K. Now we will just multiply this with a very important multiple, which is the industry multiple. Let's write it here, multiple industry, and this is something that we will search on Google. Okay, so here I have already found what I need, but I'll just go back here to exemplify it. So I just Googled valuation industry multiple 2025. I checked all of those websites. I didn't like any of them, but I did like this one, nimble.net, which has, let's say, sales multiples, EBITDA multiples per country, and here I am using US as the benchmark. So first, it's showing me a table with the average size of a company. So 2 to 5 employees is small, 6 to 25 medium, 26 to 99. It's not large, but let's say it's medium still. But anyway, the multiple will be a lot higher depending on the industry. So let's just compare, okay? Let's take this industry here, IT services. EBITDA multiple is 3.3. If the company is bigger, 5.2. Bigger than that, 6.2. So we know that we are using a small company in our example, so it will be 3.3, which is not bad, in fact. And here we'll have the valuation of the company, which will be 50 multiplied by 3. So basically, we know that this business is worth 167,000, and well, not bad, I would say. So when you go selling the business, you already have a figure into your mind. Now that you know your business valuation, you can start to negotiate with buyers, right? So maybe you are not at the stage in which you have a buyer. If you are still looking for a buyer, I already told you, putting your business for sale on online websites is not the best option. Why, Giselle? Because you will get messaged and spammed by people who want to intermediate your business, want to earn a commission selling your business, and people who are just interested in knowing how much it would cost without really having any willingness to buy it and to take it through. So it's just a complete waste of your time. It's just, let's say, 80% spam, whereas 20% is really interested in buying it, and well, there will be some money gained, which I already told you about in this other video here. And we don't want a cash game, right? We don't want these situations in which someone is trying to negotiate your business to zero value, or someone, let's say, that doesn't see the value that you see, that doesn't have the same goals. So here I am teaching you how to source those motivated buyers. And why they are motivated buyers? Because they have the same goals as you, they share the same values, they see synergy. Let's go. Okay, so let's suppose that you are at a stage in which you are searching for a buyer. If this is the case, we need to find those buyers, right? And to find a buyer that will value your business and that will understand your goals and your needs, you need to find buyers that have some sort of synergy with you, just like I explained before. Synergy with your company. Maybe they are in the same industry, maybe they have, let's say, complementary product or services. So it's always better to look for people who have, let's say, commonalities with you. So you can reach out, establish rapport, create network, and eventually we'll find a buyer for the business. You reach out to someone that knows someone that knows someone who is searching for a business, and eventually things come true. Those are the people that will value your business the most, okay? People who have synergies with you and who share the same goals with you. So here, for example, we are in Sales Navigator. Sales Navigator is my favorite tool for outreach. This works in case you are buying businesses as well, but in this example, we are talking about selling businesses, of course. So within your Sales Navigator setup, you will basically, let's say at the headquarter location, we are sourcing business in the United States, and let's look for people who are, let's say, for more than 10 years, right, in the same company. North America, let's look for an industry. I generally like the food and beverage manufacturing industry. And of course, let's here add a company size, company headcount. In the previous example, we were doing the valuation for a small company, right? So let's select a small company, 1 to 10 employees. And here you see we already have a list with all of the names within that industry, and we can just reach out to those names. Yeah, we can select all of the contacts, save them to a list, and get in touch directly with them. Another tool that I like is Apollo.io. With Apollo.io, you will, get the same results more or less. Apollo.io has, let's say, some sort of automation when it comes to the outreach. Of course, you can always use some other software that can automate the LinkedIn outreach. Apollo IO, I believe, has it natively. So again, here we will just select the location. We will select the employee sizing, industry, food and beverages. And here we are. Here we have a list of emails ready for outreach. Of course, you need to qualify those leads, of course, before reaching out. Same if you are working with Sales Navigator. Same if you are working with Apollo IO, it all depends. And of course, if you want to outsource that, you can always go to Upwork, which is a website where I always outsource stuff. For example, here I just typed in Sales Navigator, and you will get a lot of profiles here which you could outsource the mail marketing and messaging from. I hope this helps. So it's very important that you don't lie to the person who is willing to buy your business, right? We need to be fair here, fair on any problems that we have, problems on, client concentration, on the product supply, costs. We cannot just not disclose all costs of the business to the buyer. First, it's not fair. Second, this could bite you back in the future. So this will eventually be shown in the due diligence. And if this is shown at a later stage of the deal, your valuation will have to be revealed. There will be, let's say, some broken trust in between you and the person who's willing to buy. So just be an open book. This person, the buyer, is the one who will continue your legacy. So it is a very exciting opportunity that you are giving into someone else's hand. Just be fair. Okay, so let's suppose that we are at a later stage now. We have the evaluation, we have found the buyer, and we are negotiating the terms. What is actually negotiating the terms is how the buyer will pay for it, right? Some people will pay for cash up front, some people will ask for seller financing, some people will have to borrow money to pay for your business. Some people will offer you, for example, to stay as a non-executive person for some equity and maybe some compensation. It could be. There are many ways, again, in which you could structure a deal. And it's not only the buyer who can offer it, it's also you, the seller. So again, in my bio, you can find a free template on how to structure your deal, get creative. And cash is not the only possibility that you have. Of course, it's marvelous to receive all of the portion up front, but that's hardly the case when we are talking about small businesses. Yeah, that's more the case when we talk about medium-sized to large businesses, and not even the whole cash up front. So it really depends. It really depends and needs to be analyzed. So agreeing on terms is not only agreeing on the payment terms, it's also agreeing on a transition plan. The transition plan is how you will actually exit the business, how you transfer your knowledge to the buyer, and how all of the processes that you know very well, all of this knowledge that you have acquired throughout the years, how you transfer it to the owner. Generally, a transition plan lasts from 30 to 90 days, and it always depends on what you agree with the buyer. So really talk it through, agree on terms, align a plan, really a step-by-step plan so you can exit, and the person who is buying the business can take the full control and ownership of your then company. We're talking about outline terms here, but this is generally what we do as a letter of intent. So the letter of intent is the intention to buy your business, right? You have outlined the valuation, the payment structure, the transition plan in the letter of intent. The buyer will not buy it straight ahead. They will first do a due diligence. And the diligence will take, let's say, 45 to 60 days. Of course, depends on the size of the company. But the buyer will then take a really in-depth look into everything: sales, products, costs from top to bottom, from sales to costs, from supply chain to back office operations. And this is where, let's say, anything that's not covered before will then be uncovered. And this will define your final legal agreement. So let's say that you go from letter of intent to legal agreement, where you will outline how you will proceed. I already mentioned the transition plan, the payment plan, and if anything else has come up during the due diligence, it could be that one, your valuation will be revealed. It could be that two, your transition plan will be extended, and it really depends. It really depends. The final legal agreement can be outlined by an attorney. What I do personally is I outline the legal agreement alone with the founder, the seller, or the buyer, and then I ask the attorney to reveal it. This means that this gives me full flexibility on negotiating the terms, and then I can just guarantee that everything legal-wise is covered in this final agreement and is revealed by someone with the practical knowledge to do it. Then you just, register everything at the notary. Probably there will be some transfer of SPVs. If you don't know what SPVs are, it's a sales purpose vehicle, the LLC, LTD, etc. that you use to purchase the business, and then the deal is done. You can, of course, also choose to outsource the entire deal to a broker or intermediary. I personally don't like doing so because I believe they drag the deal down and it takes a lot of time to close. So I prefer really negotiating one-to-one with the seller or buyer, and then I can take it through letter of intent, first valuation, letter of intent, due diligence, and then the final legal agreement. So I hope this video has supported you now that you can sell your business, and well, see you next time, right?